You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the optionsinsider.com and co-hosts Alex the Viceroy Jacobson from OptionsXpress, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by OptionsXpress by Charles Schwab. Don't spend time worrying about your broker at OptionsXpress by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. OptionsXpress by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. OptionsXpress by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, welcome back to the Option Block. We are, of course, your bi-weekly source for all things options related. My name is Mark Longo from the optionsinsider.com, as well as from the ever-compelling, ever-satisfying, at least we hope, Options Insider Radio Network. And if you're caught up in all this Flash Boys hype these days, you want to know more about what's going on there, you want to know, hey, are these markets really rigged like everyone's saying these days in the various outlets? Well, check out the latest addition to our network, the Trading Tech Talk program. A lot of cool stuff on there, including, as we speak, we are uploading the next episode, our great Flash Boys debate, where we dive deep into the HFT Michael Lewis Flash Boys fray and really have some interesting back and forth on that show. If that stuff interests you at all, then check it out. I think you're going to like it. You can, of course, find Trading Tech Talk wherever you find this fine program and every other program on the old Options Insider Radio Network. Speaking of the network, while you're there, make sure you check out our app in the App Store, the iOS App Store, the Google Play App Store, even the Amazon Kindle Fire App Store. Of course, you can stream every episode we've ever done here in the history of our network, going back 7.5 years now, as well as download any episode you want. And, of course, hit that feedback button. Send us instant feedback, instant questions, instant comments directly to the hosts of your favorite program. It's really cool. A lot of you guys taking advantage of it. We love to see it. So check it out if you haven't already. The Options Insider Radio Network mobile app. I think you're going to like that one as well. And joining me on the old all-star panel today, a little bit truncated ahead of the long holiday weekend, but nonetheless full of content, full of excitement. Starting off with the man who is always full of excitement, none other than Uncle Mike Tusaw from RCM Asset Management. Uncle Mike, welcome back to the program, sir.
I am just full of excitement today.
Whenever I need my daily dose of excitement, Uncle Mike, I turn to you.
I got it. It just never ends. I can't get any more excited than I am.
And the counterpoint to all that excitement, the man who likes to throw a wet blanket on all of our enthusiasm here on the show with his reality and his harsh doses of shining light on everything, none other than the Viceroy himself, good old Alex Jacobson from OptionsXpress by Charles Schwab. Mr. Viceroy, welcome back to the program, sir.
Just threw the Viceroy hat in disgust, almost hit someone. But good to be back today. Real interesting day because of the early expiration, and we'll talk about that as the show goes on.
That's your role here on the program, Alex. You're here to calm us all down, to disabuse our listeners of any of their wild preconceived notions, and in generally give them a hard dose of reality, which they need sometimes.
So when I was single, that's what we called a wet blanket.
I would never say such a thing, sir. A harsh dose of reality. You're like the Judge Judy of the show here. I kind of like it.
Well, it's good to be here today.
All right. And with the team assembled, we're going to dive right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, and like the man said, it is time for the Trading Block, the portion of the show where we break down what was moving in the old markets, what was lighting up the old tape today. And from a broad index perspective, not a whole heck of a lot. Most of the major indices essentially unched on the day. The first time we've had that in quite a while. The markets have been exhibiting some nice realized volatility of late, and that's starting to, at least for today, at least taking a bit of a break, a bit of a breather. Of course, we have a truncated week from a trading perspective. Tomorrow is a day off, so that, of course, was weighing on the volatility index, a.k.a. the VIX, coming off nearly a full point to 13.36, or about 6% on the day. That, of course, reflecting a lot of people closing out for the long weekend, not wanting to hold on to their longs and just not wanting to pay all that decay in spite of what's been going on in the broad marketplace. That's par for the course in most of these holiday weekends. Nothing too surprising there. Speaking of surprising, Uncle Mike, anything really catch your eye? Anything really surprise you in today's activity?
I'm surprised Apple had the little run-up like it did going into the earnings announcement today in 10 minutes. So besides that, I wouldn't say I saw anything too surprising, but I wasn't expecting Apple to pop like it did. I mean, it's up 1%, so it's not a huge amount, but I was figuring we might be a little bit more flat going into earnings.
What about the rest of your many and diverse myriad of holdings? You have gold, you have silver, you have all of your favorite biotech stocks for all your little grandmothers out there. You put them all in, the $3 biotechs. You love all that stuff. So anything else catch your eye out there?
Well, I try to short the $3 biotechs as much as I can for the grandmas.
I thought that was implied in my statement, but
got it. So, no, I mean, I'm just looking across my screen here. FXI, China was flat today, up 9 cents. GLD came down a little bit, but nothing too much. And then silver was SLV was totally flat on the day today. The only thing, what I'm doing going into this weekend is I'm trying to stay as long premium as I can for the most part. I'm not really selling anything just because of the fact that we had the holiday week this week. We also had a lot of numbers this week. So with that, I could see a possibility of a lot of movement over the weekend one way or another. So I prefer to be long premium going into long weekends in this type of a situation.
Alex, same question for you. Anything catch your eye? I know it was, of course, a truncated week. That meant expiration was a little bit goofy this week, so I'm sure that caused a lot of frantic and frenzied phone calls over the trading desk at OX today.
Yeah, they were preoccupied with people regrettably misunderstanding expiration. The AM cash settled indexes stopped trading on Wednesday. And I think a lot of people just thought, well, if Friday's a holiday, everything will stop trading on Thursday. And so that created a lot of phone calls, a lot of activity. I will tell you one surprising move today is our 10-year, which, speaking of wet blanket, I always talk about the sovereign rates and how those are, I think, a precursor to what's going on, especially in the geopolitical front. Our 10-year traded almost a 4% range today. That's a 65 realized vol, and I can't explain why. And I think for the last 2 weeks, we've had this market that's, down 200, up 200, down 200, up 200. I think I've called it a schizophrenic market. I don't understand the move in the 10-year today, and I suspect maybe that's extra volatility going into the holiday weekend, but I'm a little surprised by the move today. Not the direction of the move today, but the size of the move today. Now, so, we're back up in the 270 area when we were at 260s, low 260s this week. So that's a bit unusual. And that seems to be a precursor to the belief that we might be seeing a little inflation coming back. And so next week should be, I hate to say a difficult week, but with that kind of vol in the 10-year, next week might be, again, a day trading week with a lot of ups and downs.
Speaking of ups and downs, we had some earnings earlier this week and some more coming out today. Of course, earlier this week, we saw Google announcing, and it seemed like, at least contrasting to the most recent announcement from last quarter, this time not really running over all of the premium sellers out there. If you were steadfast out there, you could have come out all right on the premium selling side of the fence. We also saw before the open today, one of my favorite names, Chipotle, also known as the stealth apple to some. Of course, they've diverged a bit, but they're getting a little closer again. Except for today, Chipotle taking it on the chin with the earnings coming out before the open, dropping about 6% on the day to about $5.20 or so. Of course, that 5.5 straddle went out at about $40, so still premium buyers underperforming there as well. So far, with only a handful of big results in, at least so far, it seems like premium buyers haven't exactly been knocking it out of the park. But there still are quite a few names scattered throughout the coming week, and a lot of you guys love the tech stuff. So we're, of course, keeping a special eye on the tech stuff. Good old Andrew can't be here, but Zynga coming up next week and a bunch of other cool stuff on the horizon. We actually have right now, speaking of tech, we do have AMD after the bell, but not a whole heck of a lot to really parse there. This is a $3.70 stock. I think Alex would say this stock pretty much is an option at this point, so not too much in the way of parsing. Looks like they're up a wee bit here in the after hours, but given the paucity of strikes, given the paucity of volume out here, not exactly a huge trade to parse in AMD land. Looking abroad a bit to some of the other interesting stories that were gumming up the works in derivatives land since our last episode. Actually, it was last week, but it's developed more this week, of course, was the big outage on the CME last week. Everyone's going on these days about Flash Boys and HFT and how they're running amok with the marketplace, and the old pit trading open outcry is extinct and the way of the dinosaurs, and yet it came in handy last week, in particular on April 8th, where CME, at least on the ag floor, experienced a pretty severe outage. All of their electronic systems essentially going down. So what happened, everyone had to jump back into the old pits and dig out their old trading sheets and all the other fun stuff that they used to use and start slinging out there. Now, there's still a decent pit presence in the grains and some of the other things out there in CME anyway, so that certainly helped cushion the blow. I know a lot of traders over the last couple of years have migrated from the equity world into some of the commodities, particularly the ags, because there's been a good pattern of consistent volatility for them to trade. But still, it's interesting to watch this, that there still is that safety valve in the marketplace. So if the worst does come to pass, even in products like the ags, there still is a bit of a core pit trading mentality, pit trading ecosystem that we could fall back on to keep things flowing. It may not be the smoothest, may not be the tightest markets that we're seeing in the world, but they can at least still function. Alex, did this catch your eye at all, this news last week? I know you keep a broad view of the industry here. Did this one come up on your radar?
Yeah, and it's never a good day for anybody. I mean, I've spent most of my career at two exchanges, and often when there would be technology glitches, somebody somewhere would always say, you're probably happy about that if it happens at a competitor. You're never happy about these things, and even in pits that still physically exist. Some of these technology glitches mean the orders can't get in, that the reporting system is down, and it's, this is sort of a constant debate. Was evolution good? Is high frequency trading an unintended side effect of electronic trading? And it's a long conversation. It's interesting to see some of this stuff play out in the news, and to see who comes up on which side of what, but never happy when there's technology hiccups or glitches.
Well, speaking of HFT firms and technology and its impact on the marketplace, of course, I talked about Flash Boys earlier. That's been a driving narrative in the markets for a few weeks now. You guys first touched on it on the show a couple of weeks ago when I was on vacation. Didn't have a chance to really chat about it with you guys then, but that story has continued to evolve since then. I know your firm, Alex Schwab, has really jumped into that fray with both feet. It's been interesting to watch the various responses from the various firms on this issue. almost diametrically opposite in some cases, which is pretty interesting. And now we saw the continuation of that with a lot of firms, in particular 6 HFT firms getting subpoenaed. A couple Chicago firms on there, including Jump Trading and Chopper Trading on the list of subpoenas. So they're starting to reach out here into the derivatives markets as well, which is kind of interesting. Of course, Citadel and GetGo were both hit pretty hard in that book as well. Both have big operations out here in Chicago. So it's interesting to see how this has been unfolding. And just in general, watching the narrative play out. Again, like I said, we had a very, very, very lengthy debate about this on our Trading Tech Talk. Check that out if you want to hit on that a little bit more. But Alex, you and I haven't had really a chance to talk about it ourselves here on the program. I know your firm has come out with some interesting comments on the HFT ecosystem in general, but what's your take on what you saw from Flash Boys and what they're saying out there in the media about these markets being rigged and HFT being a cancer and all these other things that are being bandied about quite a bit?
Yeah, so I actually went out and bought the book and read it, and being the wet blanket geek I am, I watch a lot of the nighttime Bloomberg and Charlie Rose, where there have been a number of people on talking about the challenges to HFT. I'll make 2 comments. Number one, rarely does a firm like Charles Schwab deliver that clear of a message. Generally, when Charles Schwab has a press release, it's balanced and it's kind of measured. And Chuck came out really with a strong voice on HFT. And so 2012, the high-frequency firms made $1 billion. Somebody paid that, right? That transfer came from someone else. And if high-frequency trading, if flashing quotes, if banging a quote and then sweeping the rest of the system ends up costing the users $1 billion, then it's a cancer. It's a problem. Everybody talks about adding liquidity. And started the ISE, we went through a lot of kind of iterations of who's a customer and what's a customer. In early days of the ISE, probably 40 to 50% of our volume came from SIBO market makers. And, everybody would focus on that and say, look, they're not a real exchange. And then, of course, we would say, if the SIBO trades here, you ought to trade here. The industry at some point has to answer a question, which is, who is a customer? And how do we empower that customer? And I'm going to use the term genuine customer. So a Schwab customer, an OptionsXpress customer, an RCM customer that's an individual investor, whether they have $1,000 or whether they have $100 million, they're a customer. And the marketplace needs to present them with a level playing field. And if high frequency made it more expensive for them to trade, then that's a concern. I listened to Arthur Levitt the other day on Bloomberg, and Arthur's a former chairman of the Amex, and he talked a lot about how trading costs are down and how that served customers well. And trading cost is not everything. Friction is what you have to look at. And friction is cost of trading, bid-offer spread, and slippage. And clearly what we've seen in the last few years is quotes going away, quotes flashing. So you say, well, look, I can trade at 1/10 of a penny. I can trade for low transactions costs. That's better. It's not if I can't get stuff done. And in fact, one of the debates that was going on before this, even before the HFT concerns, was this debate about low liquidity stocks. And should we go back to nickels? So instead of seeing 300 up, you'd see 2,000 up. And it's clear that the SEC looks like it was going in that direction and going back to nickels. You have to look at the whole picture. And if they took $1 billion out of the market in 2012, somebody paid that billion. And we got to take a hard look at it.
It is interesting. There are so many ways to parse this issue. I like what Blair said on our Trading Tech Talk show. It seems like there is an interesting way to solve this. Maybe the industry could implement this. The SEC could implement this like they did the penny pilot. Maybe they do a pilot for this as well, where they start charging for cancels. That seems like it's the quickest and easiest way to get to the heart of this matter. People have to pay for cancels. Guess what? All these front-running, flashing, elusive orders start costing them money. They start going away. And that'll be very quickly and demonstrable to see what the impact on liquidity is, what the impact on spreads and market is, and then all of this theoretical back and forth. Are they adding liquidity? Are they not? We'll see it plain and clear right there if they are or not. And the retail customer who says they're being disadvantaged by this, they could see the impact for themselves as well. And they could then determine, wow, these spreads are now wider, so it may cost me more, but I'm also not being front run on these little orders. So it's a little bit of a back and forth. But yeah, there is a lot of interesting stuff. I think we could debate this the entire show, but this is A, not the purview of the show, and B, I want to make sure we have time for some listener mail. But I want to just get your thoughts on it, Alex, because I know you and I haven't had a chance to really chat about it. Again, if you want to hear more about this issue, very top of mind right now for a lot of people I know, surf on over to Trading Tech Talk. A lot of cool conversation about this very issue, this very book on that show. But now it's time for us to keep on rolling right on into our next segment, The Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for The Odd Block.
Everybody, welcome back to The Odd Block. This is, of course, the portion of the program where we break down the interesting, the weird, the sometimes wild activity that we see lighting up the old options tape today. I'm going to kick things off with a name that some of you may have heard of, called Wal-Mart. Wal-Mart, I'm not sure how you pronounce that. Ticker symbol WMT, closing today $77.66. This is an interesting one. We haven't talked about it in the Odd Block in a while. This is, of course, the bellwether for retail here in this country, averaging about 20,000 contracts a day, doing 34,000 today. So it's doing a hefty volume. And we pointed out on the site earlier today that it's kind of surprising, actually, when you look at the numbers, how little Walmart actually does. You would think of Walmart being this brand name, so iconic in this country for the shopping experience, would do a heck of a lot more options volume than it does on a daily basis. But be that as it may, earnings are coming up, and that's where this next trade seems to be focused. In particular, we saw a pretty sizable out-of-the-money call buy going up here in good old WMT. The May 80s going up for some pretty substantial size, over 10,000 contracts, 10,849 to be precise. Of course, again, some sizable open interest, about 18,000 contracts. This doesn't appear to be a close. It looks like, it's possible that someone is using this out-of-the-money call buy to hedge some short stock. That is possible, but given the fact that earnings are on the 15th, it seems much more likely that this is an out-of-the-money, the typical out-of-the-money call play going into earnings that we see quite a bit here in the old Odd Block. Of course, I should point out, too, 10,000 of the 877 halves went up today as well against 22,000 open interest. We didn't have a chance to profile those. That trade wasn't up yet when we first started writing it, but it is possible that those two trades are linked. Maybe they're rolling a little bit as well, so we'll have to dig into the open interest tomorrow to see for certain, but still some interesting paper going up in Walmart, a name that is surprisingly thin. Uncle Mike, we joke, I should say, really on the show about all the different stocks you like to put the different grannies in over there. But Walmart, pretty big, bellwether, blue chip type name. You ever play around in this name?
Not too much in the Walmart world. I do think that with earnings coming up, I agree with you that this is a pre-earnings style play is what it's looking like on this. And it'll be, hopefully for him, it works out. And it's just kind of one of those things that maybe he knows something on Walmart that we don't. How odd.
Indeed. How odd indeed. All right. Next up in the old Odd Block, another name we haven't checked in on in a while. This is good old Western Digital, ticker symbol WDC, closing today $91 and some change, up about 77 cents on the day. This is the name that does about 5,000 contracts or so a day, doing about 22,000 today. So doing some size paper today. In particular, what we saw looked like an opening call spread here out in May. All the activity is in May today. In particular, we saw the May 95 par, the May 95 100 call spread going up 5,000 times, so that amounted for about 10,000 of those contracts. Not a heck of a lot of open interest, about 2,200 open on the 95s, about 600 open on the par, so not a closing spread by any means. And it looks like, digging around, we didn't see much stock or anything else going up with it. It looks like it to be essentially what it appears to be on the surface, an opening bullish call spread here in good old WDC. Again, earnings are the 30th. This would appear to be an earnings-related play. 2 earnings bulls coming out of the gate here in the old odd block. Now, let's contrast that a bit. We just talked about Wal-Mart getting some bullish call buying. Well, doesn't seem to be the same case over there in their arch rival, their nemesis even, Target, closing, or ticker symbol TGT, closing today $60 even. And what we saw in Target was a little bit of a different story. In particular, we saw the puts being pretty active. It was the 860 puts went up 5,000 times when we profiled it, a total of 6,500 contracts on the day on about 24,000 open interest. Those appear to be a closing sale. And then on the other side of that, against that, we saw the May 60 puts going up for about the same amount and doing a net debit of 85 cents on this trade. It looks like this guy is rolling his bearish position here on Target. Of course, this is bullish volatility and bearish to stock. Again, we didn't see any stock really going up with this, so it wasn't tied. Looks like this guy has a bit of a downside view here. Didn't really happen in his time frame, and he's rolling, not even up or down. He's just rolling straight out to May, 1-to-1, 8 May 60 put spread roll. So this guy perhaps not having the same love, the same bullish outlook for Target that our other friend had there for Walmart.
You know, it could be because of the size that's involved with this, and maybe the guy's rolling his contracts in Target, like you suggested, and perhaps maybe he's concerned that there might be a big run-up, so to speak, in the near term. So what he's doing is buying some calls on Walmart, and this guy has a lot of premium to play with as he's doing it, from what it looks like.
And last, but certainly not least, we have, I believe this is a newcomer to the iBlock. At least we haven't talked about them in any recent memory. This is Lloyds Banking Group PLC, of ticker symbol LYG, closing today at about $5 even, pretty much unched on the day. This is a name that isn't really a size options player, doing about 700 contracts a day, except for today. We saw some pretty sizable activity. They ended up doing about 24,000 contracts out here. And before you say, whoa, that's crazy, it is indeed crazy, but it's not as outright crazy as you might think, because it looks like once you start digging into this paper that it actually is a pretty sizable close. Someone came in and pretty much just took all their April off the books. In particular, the April 3 and 4s, this trader was long them, and he was short the 5s against those. He came in and took off 16,000 of the April 5s, 6,000 of the April 4s, and about 1,500 of the April 3s. So sold out the 3s and 4s, bought the 5s. Pretty sizable close here. Other than that, this is one of those names, $5 stock. Not a whole heck of a lot. Other paper out here, someone, again, having, I guess you can call it a two-saw style stupid on a bit of a ratio, and closing it out here in Lloyds Bank of London. But now it's time for us to keep on rolling right on into our next segment, a.k.a. the Alex Block, a.k.a. the Viceroy Block, a.k.a. the Express Block.
The Express Block, brought to you by OptionsXpress by Charles Schwab. OptionsXpress by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. OptionsXpress by Charles Schwab is the online broker for all traders. Best of all, OptionsXpress by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsXpress.com for your free account. OptionsXpress by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody. Like the man said, this is indeed the Express Block, the portion of the show where Alex takes us deep behind the scenes into the land known as OptionsXpress by Charles Schwab. Mr. Viceroy, what caught your eye, as you mentioned at the top of the show? A bit of a frenzy about this shortened expiration week. So what in particular caught your eye about that, as well as some of the other goings-on over there at OX today?
Well, regrettably, there was some confusion with many of the folks who trade indexes as to what was settlement this week. And when I queried Grigas and his crew earlier today, they said lots of calls relating to the funky expiration. And I paused for a minute and said, I'm not even sure what expiration, what happened. And they just reiterated the fact that today's expiration, today, in a sense, is expiration Friday, even though it's expiration Thursday. But that means if you were trading the SPX, the NDX, or the Russell, they settled at the open this morning, and Wednesday's close was the last time to trade. And that caught many people by surprise. There have been a couple surprises in the last 2 months. One was the very unusual SPX settlement at the March expiration, and of course today's early in the week April expiration. And it just tells you that you need to have a good sense on, I know this sounds corny to say what the calendar looks like. This is just a story that you tell over and over again in the options industry. And in the 40 years I've been around, you sometimes, I hate to say chuckle, but it's not the right term, but that, that Monday call that hits the trading desk and says, my options expired on Friday, I want to do something today, what are my choices? And you kind of delicately have to tell the customer, you have no choices. They expired and they went off. And, some small percentage of people still have that, the conspiracy, theorists. And we saw that a lot in the SPX March settlement, where it settled at a price that you hadn't seen. And of course, you take the time to explain to a customer how settlement occurs, and oftentimes you can tell they're just not listening. They think they've been handed the short end of the stick. So that was a lot what was going on today. Obviously, the one name today that was lighting up the tape was Google, with earnings yesterday and the stock down 20 points today. But we also saw some positioning for next week, especially in Facebook, where Facebook's earnings are Tuesday of next week, and people trying to position themselves accordingly for what they think is going on in Facebook. The paper here has been pretty bullish in Facebook, and the activity today sort of carried that forward. We saw a lot of people positioning themselves with the expectation that the earnings surprise in Facebook will be positive. But I remind everybody that positioning and, what's going to happen next week are two very different things. So overall, it wasn't a very busy day with the markets in a pretty narrow range. The only index that really showed any spark today was NASDAQ. And as Mike mentioned earlier, that was led by the activity in Apple, which was a little bit of a standout today. And, shortened week, so folks need to be aware of the calendar.
As you're talking, I'm just pulling up the volume we're seeing here on Facebook, and you're right. It's bulls galore. There's activity on the April week twos, which are, of course, the primary earnings option, all the way up to 75 handle in some cases. Some of that could be closing. 2,400 of the April 70s went up today. Nearly 3,000 of the April 65s. Again, these are just week twos. These are essentially weekly options at this point. 1,300 of the April 66s. So they could be closing there, but I'd imagine the bulk of it was not. And it's time for us actually to keep on rolling right on into our next segment, because I want to make sure you guys get a lot of time. It's time once again for the mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody, welcome to the Mail Block. This is my favorite part of the show because it's your part of the show. It's the chance you guys get to share your questions, your comments, your insights here with us on the old All-Star panel. And usually I have a rule, one question per listener per show. But this is one of our listeners who got caught up in that little snafu we had with our feedback system on our site. So this question actually got delayed a bit. So I'm going to be lenient for him and answer a couple of his questions. And this comes in from listener John B. And he writes, I have a losing YGE, that's Yingli Energy put position, that expires in March. Again, this was delayed a few weeks, which is why we're a bit behind. I'm down about $2,200, but I offset some of those losses by shorting and going long the YGE stock. My question is, what should I do with the YGE losing position? Just let it expire or sell it? The option is trading around 10 to 15 cents, I believe. The second part of this question is, if I stop trading YGE stock and let the options position expire worthless or sell it, can I declare the YGE losing position as a loss for 2014 as long as I don't trade it for 30 days? Well, two interesting questions. The first one is you have stock and you have puts against them that kind of haven't really worked out for you. So they still have a little bit of value, it sounds like, and you didn't really illuminate what your outlook is for the stock going forward. That would, of course, play a big part in what we recommend. But it sounds like you're not exactly too enthusiastic for these puts to really start coming into any sort of value. So if you have 15 cents, you can still harvest out of them and take them off the table. I'd recommend you probably do that. 15 cents is better than nothing. Again, I don't know how many you have, but again, if you're worried about it that much and it doesn't sound like you're too enthusiastic about this position, then I would encourage you take that 15 cents off the table and get to work on the next trade. The second question is, if you sell the puts, and then you declare this a YGE losing position as a loss for 2014, as long as you don't trade it for 30 days? And the answer is yes. It's like pretty much any other investment. If you buy a stock in 2013 and you sell it in 2014, that's how the gains are calculated, by the length of time you hold it and the year in which you actually sold it. So it's not, you don't have to go back to 2013 to take those gains or anything. So in this case, yes, if you have those puts and you sell them out, you can take it as a loss for taxes for this year, which you'll, of course, will report next year. Uncle Mike, do you agree? You think you should hold on to those puts?
You know, oftentimes when you see things out there for a nickel, you keep thinking, oh, well, it's a cheap lottery ticket. And what I always like to tell people, and this is kind of the rule that I like to use myself, is that if I have something that's, let's say that I made a bunch of money on a credit spread and I just close out the short leg because maybe that would be easier to fill, let's say, and I have the long leg still sitting on the table at a nickel, you could view it as a cheap lottery ticket, but the way that I see it is that money, would you pay a nickel for that option that day to get into the trade? And my answer is always no, and so that's why I always get out of it. The only time I wouldn't get out of a trade like that it's so cheap, is if there's absolutely no bid on it. And if there's no bid on it, then I'll just let it sit there, and then it's a cheap lottery ticket because I'm not going to be able to sell anything on it anyway. So if you have 10 or 15 cents, unless you're just unbearably bearish on something, which in this case it sounds like you're not, I would suggest getting out of it.
Mr. Alex, same question to you, sir.
I don't know why, but I have the impression that the listener is a lightly capitalized trader. And when you're a lightly capitalized trader, if you're not trading with lots of money, risk management's got to be paramount in your thought process. And you have to be more active. And I would have looked at an alternative strategy, an adjustment, or rolling the position much earlier than when they're worth, nickel dime kind of things. So, yeah, the interesting thing, if you're a small trader, modest size account, risk management is equally important to putting on the initial position. And when you put that position on, you should establish some parameters of when I'm going to adjust, how I'm going to adjust, and don't be scrambling when the trade has gone against you with, okay, now what do I do? So I'd be a bit more proactive.
Indeed. 3 votes there for taking the 15 cents and moving on. Speaking of moving on, well, we're not going to do that just quite yet because he has one more part of his question. He says, part 2, final comment and question. In the past year, I sold my 2 businesses here in Long Beach, California, and have started trading pretty seriously. The past year or so, my broker labels me a pattern day trader. My commissions went from $10 to $20 a day to about $100 to $200 a day in October 2013. Well, all those trades have amounted to, let's say, 1,000 pages of trade records. Can you recommend any tax software or system strategies that would simplify or organize all that trade data? I'm even open to accountant CPA referrals if they are licensed in California. I'm not sure how I'll do my taxes for this year. I figure I'll gather all my statements and trade data and call a few accountants. What do you think? If you can't answer all these questions, please answer the tax one. The majority of my winning trades have come from options. I heard they were risky a while back, so I just stayed away from them. Lo and behold, my options education has opened a completely new world for me. Anyway, I like your shows, all 10 of them. I listen to the Options Insider News Rundown, Bootcamp. I also listen to the OIC Option Strategies for Investors. And he wants to know if Dan Passarelli is on this show. He is not. That is the other program, Options Bootcamp. So a lot of great questions in there. There's a lot of different software out there you could do this with. I know some like Quicken and others will let you import it. But I actually like what you guys have, Alex, on the OX site, which is that Gains Keeper. It really is designed to do exactly what you're talking about here, which is take all of your many diverse trades and just boil them down to the essence and fill out your Schedule D for you and everything like that. It's pretty cool software. OX offers it to their clients. You can upgrade and get it for a charge. You can also get it standalone, though, which is pretty cool. And most of your brokers, whichever broker you use, will probably allow you to go into your platform and export your trading data in some sort of tax recognizable format. It could be CSV, it could be Excel, it could be Quicken, it could be, there is a special tax format. I forgot what that extension is, but there is a tax file format that is recognizable by a lot of the software out there. So you can export it in one of those formats. And I'd imagine if you go to Gangskeeper and pay a subscription, I forget how much it is for a year, but it sounds like it'd be worth it for you. It will do all of that netting and analysis for you.
Yeah, and in the spirit of Passover and Easter, I'll be ecumenical here and tell you that I think pretty much every major brokerage house has some type of software they make available for free that is user-friendly with their site. But I want to go to the first part of his question because that kind of disturbs me. He says he was categorized as a pattern day trader and his commission costs went out by tenfold. So it's clear what happened when he was categorized as a pattern day trader, that he began banging out of positions. And again here, this is I'm kind of hearing stuff that wasn't in the question. I would, if your commission costs went up that much and you had sold the business, it sounds like, again, you're keeping a very modest size account. I would get the account up to $25,000, make it a margin account. You won't be subject to the pattern day trader rule unless you're really just banging stuff around. But when he says his commission cost went up, it sounds to me like the fact that he was categorized as a pattern day trader made him increase his activity. I don't like the way that sounds. I would get enough money into the account till where I can have a genuine margin account, not be categorized as a pattern day trader. If your commissions go up tenfold, something distressing me seems to be going on.
And with your 2 questions underway, I hope that does that for you, John, because we're going to move on to the next question, which is from a listener who goes by the handle Maximus. Maybe he's a fan of Gladiator or just the Tangled movie. I don't know. He writes, "Thank you for your very informative podcast on the Options Insider Radio." Well, you're welcome, Maximus. He goes on to write, "Appreciate the good work you guys are doing. What strategies do you suggest for maximizing returns using options in a small Roth IRA account with, say, just $5,000 to $10,000 in it? A stock replacement, which he puts in parentheses, selling short-term calls by buying leap, something I've extolled many times on this and other shows on this network, or credit put call spreads, triple income strategy. We, of course, have also discussed that on this network and on this show in particular." He writes, "Seems like good choices. But if you want to ensure there is enough money in your account in case you do get assigned, limits the universe of underlying equities to be trading at under $10 for any reasonable volume of contracts." And he puts in parentheses 5 contracts in this case. If your Roth IRA is just about $5,000 to start with, how do you expand the universe of underlying equities to choose from to work with such limited amounts? Thanks and regards, Maximus. Uncle Mike, this one has you written all over it. Of course, you do a lot of trading with a lot of your clients in customer accounts, and I'd imagine this question has come up from time to time. You have someone coming to you with a Roth or an IRA that has a little bit less money in it, and they're limiting their viewpoints to underlyings to correlate with the amount of money that they have. And what are some of the steps you take with those types of clients?
Well, I think step one, Maximus, is what percent of your net worth is this $5,000 to $10,000. If this is everything that you own and this is all of your money, then that's one thing. If this is just a portion of your overall net worth, let's say your net worth is $200,000, $300,000, $400,000, whatever the case may be, then you need to look at it in a different way. So let's assume for a second that this is everything with which you have. If this is your entire net worth, my suggestion would be to take 6 months to a year and paper trade, just because of the fact that even though you'd have a limited amount of resources, you could still learn, even though you wouldn't have any skin in the game, you could still learn from paper trading, whether it's diagonals, whether it's credit spreads, whether it's calls, puts, whatever. But I would suggest paper trading first. And from there, after you get some experience on that, then maybe I would take, and I'm just assuming that you have $10,000 in the account, then I would take maybe $1,000 of that and then maybe do some very limited risk style things, perhaps some credit spreads, perhaps some type of a diagonal, but something to where you have a smaller amount at risk, because if everything goes against you, you don't want to blow out $5,000 or $10,000 for that matter on one option trade. You never want to put yourself in that type of a position. You're going to be wrong at times when you trade. And if you don't manage risk accordingly in terms of asset allocation, then you need to be aware of that. So I think that step one, look at the big picture. And then step two, determine how much money you actually want to trade with in that account.
I like that he's talking about things like stock replacement. That is a great tool for someone in this exact scenario who wants to expand the universe of underlyings that he can trade without having to come in and pony up the full margin or leverage for buying that stock. So something like stock replacement will expand that universe beyond things like the cheap $10 equities. You can use stock replacement to trade stock equivalent positions in a variety of underlyings, regardless of where that is trading. So I like to see that he's saying that. The triple income may be a little bit more difficult for him because it's going to involve an underlying component. And again, if you're writing puts and you want to do more than a couple of contracts, you're going to have to start looking at some underlyings that are probably a little bit lower on the price spectrum. Again, that goes back to that problem you outlined earlier. And again, what Uncle Mike said is completely right. You want to always focus for an account like this on very, very risk-mitigated type strategies, risk-defined type strategies, verticals to simple credit spreads, things like that, where you know exactly what you have coming in, what you have going out, and you can manage it so you don't have to worry about getting assigned on some of these short legs and then worry about having to take delivery on all this underlying, which you clearly don't want and really can't afford in an account like this. Mr. Alex, what do you have to say here for our friend, Mr. Maximus?
Sage advice. The only thing I would add is don't be in a position Thursday or Friday of expiration week. If you're selling a put credit spread, if you're in a diagonal, I mean, I really like the idea of doing diagonals in IRAs where you're essentially doing the spread as kind of a cheap covered right surrogate. I like that trade a lot, but to Mike's point, the underlying tone of Mike's comment is, look, you got to trade spreads. I mean, Mike didn't come out and say that, but that's what he was saying. You got to do risk mitigated, risk managed positions. The other thing too, I would be really aggressive in risk management, and this almost goes back to the other question we had, where the thing is trading a nickel dime. I don't have a lot of money. I'm going to leave it out there. And you say to yourself, well, that's the week that they marked the SPX $11 higher than where it should have been, and that's your last trade because it wipes you out. So I would be out of every position except the long part of my diagonal going into expiration week. I would carry nothing into Thursday or Friday. I would learn one index and two equities. And I mean, I would learn the ex-dividend dates. I would learn the earnings dates. I would learn the chairman's birthday, because I want to be aware of when news hits. With a limited account, don't start looking at 10 or 15 or 20 names. If you want to come to a tool, use a resource like the Idea Hub here, where you can look at trades like that. You might want to use it as much for price discovery, as Mike said, practice account for 6 months. But look at a lot of the tools and use them for discovery. And then after you're comfortable and you think you've learned a couple of names, then I'd start trading spreads.
Now, Alex, let me ask you this. At optionsXpress, there is same-day substitution. So let's say you do everything right, you sell your credit spread, you hedge yourself, and you get assigned early for no reason. Maybe something goes in the money, there's an overnight gap or something like that. How does that process work in a Roth IRA or in an account that size when, let's just say, all of a sudden they're short a bunch of Google, if just based on they got assigned on a spread or something along those lines within the Roth IRA?
Yeah, I'm going to give you a simple answer, but I'm going to tell you it's a nightmare. Even if the risk department can help you, you've got to be aware that you can't margin an IRA. And this question comes up a lot. And many years ago when I worked at the CBO, I was down at the IRS Center in Austin, Texas, teaching the people who were responsible for auditing options. And, of course, every time I tell that story, someone's like, why did you take sick? Why did you? But when you have a problem in an IRA account, and Mike, you might have more insight here, but essentially if you have to, quote unquote, borrow money, do momentary substitution in an IRA account, you have the risk of the IRA being declared dead, which means every asset in it has a tax problem, and you just don't want to put yourself into that situation. To your point, Mike, though, it can happen. There is something that we affectionately call in this industry stupid exercise, where somebody exercises something that makes no economic sense, and you want to work with your broker, talk to their trading desk, and see what their risk department can do to mitigate that shouldn't have happened event happening.
So in theory, then, if even in an IRA account, if you get assigned, even if it's stupid assignment or stupid exercise, then the IRS can declare that account, that IRA, null and void if they want?
I'm not giving tax advice here.
Or gray area.
I was just reminded when I was down there, that was one thing that we talked about, and it's not a pretty thing to have happen. The brokerage house is not only your broker in an IRA, they're also the custodian, the fiduciary. And that's why a lot of times people will say, well, why don't brokerage houses allow this in an IRA, and why do some allow it? For example, at OptionsXpress and Schwab, there are different lines in the sand of what's allowed in what we call qualified accounts, ERISA accounts, IRAs, Roth IRAs, and things of that nature. And sometimes the trading desk can help you, but sometimes these things will happen after hours. And it's just a nightmare, so you want to do everything possible to avoid it.
And that's why I like the stock replacement angle, but I was a little bit more leery to suggest that he does continue with the other side of it, which is, of course, writing the very near-term calls to finance that. It usually works, but in an account of his size with this type of nature and all the problems we just listed, it could perhaps cause more headaches for him than he wants. So maybe stock replacement is the safer of the two options to go with. Unfortunately, that is all the time we have for the listener mail. That's also all the time we have for this episode of Option Block. But before we go, I want to check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods that may interest you. Starting off with you, Uncle Mike Tusaw, what is coming down the pike in the old RCM webinar train?
Iron butterflies versus iron condors this Tuesday after the close. Tune into it. We are excited about the webinar. More information at www.rcmassetmanagement.com/webinar.
And then stay tuned immediately following for Versus the Stupid, which everyone's waiting for.
One of these days.
One of these days. And last but certainly not least, Mr. Alex, what is coming up in the land of OX education?
Okay, live events. The April live event, April 26th in Schaumburg. The May live event, date we've just put up, May 10th in New York City, showcasing a couple upcoming webinars on Tuesday, April 22nd. Nina's going to do the platform and site tour, and then after that she's going to do advanced orders and the walk limit product. And walk limit is still an exclusive product here at OptionsXpress, although I have heard the competition is working feverishly to do it. April 23rd, Wednesday, introduction to futures done by Mike Zaremski, the head of our futures desk. And I just want to make one quick comment, if I can, about Mike, iron butterflies versus iron condors. If you're not an experienced options trader, that is such an important concept to understand, that it's such a terrific topic. Again, in the ecumenical spirit of Passover and Easter, I will recommend that people go to the RCM webinar because it's such an important topic about whether you trade the butterfly or the condor. And I think 9 out of 10 customers get it wrong. So I would encourage them to go to RCM on Tuesday night. I know I'll get a call from somebody in San Francisco that's going to say to me, you had one thing to do and you got it wrong. So I'd encourage people to listen to Mike on Tuesday. And, of course, come to optionsXpress.com and listen to all our offerings. Everything is free. You don't have to have an account to get any of the educational resources.
And, of course, they couldn't make it today, but I'll give them a nice little plug anyway. Check out what's going on over there at optionpit.com to see what Mark and Andrew have cooking up, including their new gold course. You can check it out. I think you're going to like it if you want some more detailed, hands-on education. That certainly is the place for you. And on behalf of Alex and Uncle Mike and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, for, of course, downloading the app, and indeed for writing in with such great questions. Keep them coming, and we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.